Welcome to our training module, Foreign Exchange 101, Definitions, Principles and Overview. Why does FX matter? According to 2021 figures from the UK Office for National Statistics, most large corporations, more than 50% of mid-market companies, and 2 in 10 SMEs carry out business internationally. Many of these businesses import or export goods and services across borders. Others employ staff overseas or have international investments or subsidiaries. Most countries have their own national currencies, aside from a few exceptions, such as the Eurozone. And when businesses move money across borders, they often require the conversion of one currency into another, i.e., performing foreign exchange transactions or FX. A well-managed FX and related risk processes can help reduce costs, enhance financial stability, and improve the decision-making of any company that buys, sells, or employs internationally. What is a foreign exchange transaction? In brief, FX transactions are the actions of converting currencies, buying or selling one currency in exchange for another. These transactions can occur in the global FX market or between financial service providers such as banks, currency specialists, or fintechs and their clients. Most FX transactions are conducted electronically for reasons of convenience, speed, and lower costs. A typical FX transaction is an agreement between two parties to exchange a specific amount of one currency for another at an agreed exchange rate on a particular date. Called a value date, this date is when the actual flow or exchange of electronic funds in the two currencies takes place. FX transactions can have an explicit or implicit exchange rate, a rate at which a unit of one currency is converted into another. FX transactions usually involve two currencies, so exchange rates are always quoted as a pair. When exchange rates are used for business purposes, anyone is free to choose the format to express an exchange rate. For instance, an exchange rate of 1.25 USD or US dollars per GBP or pound sterling is the same as 0.80 GBP per USD. Sometimes the exchange rate is omitted, but it is simple to calculate by simple division if you have both the sold and purchased amounts in both currencies. We use exchange rates to standardize how we quote the prices of buying or selling currencies. It makes it easy to compare them and also see how they evolve. In the global foreign exchange market, FX rates are always quoted in pairs, where the first currency is called the base currency and the second one is the quote currency or counter currency. For example, in the exchange rate pair GBP-USD, the pound sterling, GBP, is the base currency and the US dollar, USD, is the quote currency. If the GBP-USD exchange rate is 1.25, it means that £1 sterling is equivalent to 1.25 US dollars. Exchange rates fluctuate constantly, and the speed and increment of change vary depending on the size of participants and the transactions they carry out. The so-called global FX market is a community of the world's largest banks and other financial institutions that provide prices to other institutions and large corporations. The average transaction size is in millions of dollars, and the speed of price changes and trade execution is measured in milliseconds. Accessing this market directly is a costly exercise in terms of systems and other requirements, but worthwhile if you convert billions of dollars a year, which many financial institutions do. As a percentage of the amounts converted, a transaction directly in this market costs almost nothing. For most of the developed markets, so-called G10 currencies, the spread between quotes to buy or sell currencies is measured in basis points, which means hundredths of a percent. Direct participants have access to electronic communication networks, ECNs, such as Refinitiv, Bloomberg or Euronext, to be able to see live quotes provided by other participants, as well as the prices of the most recent transactions. Any interbank market participant can see the exchange rate for a given currency pair, where the last transaction was made, and current bids and offers to buy or sell a standard amount of that currency pair. These so-called market or interbank prices are used as a source and also as benchmarks for other transactions completed away from the interbank market. Most businesses, however, obtain FX prices from their banks or other FX service providers, FX brokers, money remitters, fintechs, who update their prices less frequently and, more importantly, add their own markups or spreads to the prices that they quote. When a client trades with their bank or service provider, the latter has a financial risk that exchange rates move unfavorably. To cover the risk, the bank or services provider then has two choices. A, to offset that exchange transaction against other client transactions, or B, most of the time, to carry out an offsetting transaction in the interbank market. Hence, the additional spread that is added is there for three main reasons: to cover the costs, to make profits, and to avoid losing money on client trades. As most FX transactions happen electronically, there is no physical exchange of the currencies, but electronic funds underpinning the transaction still need to be transferred between parties. When banks make a standard FX transaction, also known as a spot FX transaction, they agree to exchange funds, usually within 1 or 2 business days after the transaction date. The date at which a transaction took place is called the transaction date, and when the funds are exchanged, settled, is called the value date. The delay between the two dates has been historically needed as the interbank market is open to participants around the world that need to process these electronic transfers without any errors or failures. And this is also the reason why, whenever a client needs to execute a large FX transaction, banks will typically quote a standard price with a value date in 2 business days. Increasingly, financial service providers can also offer FX transactions that settle on the same day or the next business day. This is done for convenience reasons, to allow their clients to send foreign currencies without unnecessary delays. Each provider will have a specific cutoff time for specific currency pairs until such transactions can be made. The exchange will happen only if you provide the currency in the amount you are selling available on time. Otherwise, the FX transaction will happen the next day and may attract additional FX roll costs. FX costs are often one of the least understood costs when it comes to managing finances for an international business. Traditional accounting software produces FX gains and losses that need to be described in statutory reports, but those usually blend the impact of currency fluctuations and transaction costs and make it impossible to understand the drivers. Large corporations monitor these costs regularly. Understanding how much your service providers charge on foreign currency transactions can save thousands of pounds or dollars, even for a small business. Because currencies move all the time, and because most financial service providers don't show explicit spreads they charge above the market prices, companies need to put processes in place to monitor these costs internally, or increasingly demand transparency from their banks and service providers. Direct participants of FX markets, as well as some large corporations which can access dealing platforms, are used to seeing FX rates quoted with 2 prices, bid and offer. A bid price is the exchange rate at which the party that provides the quote, such as your bank, is willing to pay for buying the base currency. Conversely, the offer price is the rate at which they would sell the base currency. For example, in quote 1.20, 1.20, 25 for GBP USD, the bank is willing to buy pounds at a rate of 1.20, so £100,000 would cost them $120,000, and sell them at a rate of 1.20, 25, selling £100,000 for $120,150. The interbank markets also provide ongoing transparency where the last transaction happens in the market. Knowing the last price can also help in estimating how much you are being charged by your bank or service provider. Public sources such as Google or Yahoo Finance can be good starting points for smaller businesses to see where the exchange rates are in the interbank market, even if with a short time delay. The difference between exchange rates in the interbank market and from your service provider is the indicator of how much you are being charged. Increasingly, FX transactions are embedded in other financial services, but it is still important to understand how much these services charge for the convenience of embedding FX conversions. For instance, PayPal or Stripe can charge anywhere from 2 to 5% for FX conversions. Finding a way to collect funds in foreign currencies and convert them at tighter spreads elsewhere can save several percent, which flows directly to your bottom line. What are different types of currencies? Most of the world's currencies are fiat currencies. These are issued by governments and have no intrinsic value in that they are not backed by a physical commodity such as gold. Their value is determined by government decree and the trust of the people who use them, and often their value is measured against other currencies instead. Examples include currencies of the majority of developed economies, so-called G10 currencies, such as the US dollar, euro, Japanese yen, and British pound. G10 currencies represent a group of major and highly liquid currencies from economically advanced countries. These currencies are widely traded and often used as benchmarks in global financial markets. These currencies belong to countries with well-developed financial systems, stable economies, and established monetary policies. Because their values are driven by supply and demand, their market prices fluctuate constantly. Anyone can buy or sell these currencies freely, and if a buyer is large enough, it can impact market prices. As a result, these are called free-floating currencies. Some other currencies are pegged or linked to another currency or a basket of currencies. This means their value is maintained within a certain range relative to the reference currency, often to provide stability and control inflation. Examples of pegged currencies include Hong Kong dollar and several Middle Eastern currencies such as Saudi rial or UAE dirham. Other currencies, such as the Chinese yuan or Singapore dollar, are pegged to a trade-weighted basket of currencies, where the weighting for each currency in the basket matches its share of the trade. EM currencies are currencies used by emerging market or developing countries. Some EM currencies are controlled, restricted, or non-convertible currencies. Because their economies are usually more fragile and currencies can suffer from market sentiment swings or speculations, capital controls or restrictions on their movement are put in place. As a result, these currencies are not as widely accepted internationally and are also called local currencies. EM currencies are generally considered to have higher risk and greater volatility compared with G10 currencies. EM currencies can be more readily influenced by factors including geopolitical events, economic instability, currency interventions, and changes in global commodity prices. Because of their instability, EM currencies are riskier, but due to higher interest rates, they can be more expensive to hedge for businesses that need to sell EM currencies. Digital currencies are virtual currencies that exist solely in electronic form. Two popular types of digital currencies include cryptocurrencies and stablecoins. While the use of cryptocurrencies by corporates remains limited, the emerging trend of central bank digital currencies, CBDCs, is likely to reshape FX markets and the payments industry in years to come. CBDCs are a type of stablecoin that is issued by central banks, serving as electronic counterparts to physical money for secure and efficient transactions. What are the world's most traded currencies? The US dollar plays the key role of the common denominator in FX markets. While the dollar is responsible for only a quarter of the global GDP and 40% of cross-border payments, it is included in 88% of global FX market transactions. This is because FX dealers in global FX markets quote the tightest spreads for currency pairs with the US dollar as one currency, making these pairs the most liquid. Euro, Japanese yen and pound sterling are next most popular currencies. You may have noticed the currency codes we used earlier. These are standardized three-letter symbols used to represent individual currencies in international financial transactions and exchanges. The codes are established by the International Organization for Standardization, ISO, in 4217 standard, and they help ensure clarity and accuracy when dealing with different currencies across various systems and platforms. Currency codes are crucial as they eliminate confusion and ensure accurate identification of currencies across different languages, services providers, and systems. The ISO maintains current and historical lists of currency codes on its official website. You can also find the list on Wikipedia. Thank you for watching our training course. If you would like to learn more about foreign exchange markets, we invite you to our next module, FX Markets and Financial Instruments.